G'day folks, welcome back to another update for natural gas and the ETFs. Now we're still hitting resistance.
I'm hitting resistance.
So before we go any further, make sure you hit that like and subscribe button to support the channel, and also reference the +1 videos for a deeper dive into our trading strategies. As of December 2025, the global natural gas market finds itself at the intersection of tight supply, rising demand and elevated geopolitical risk. Cold weather-driven demand and production disruptions have pushed prices to multi-year highs, supported by depleted storage and under-pressure inventories. Meanwhile, global LNG supply is set to ramp up through 2026-2027, a factor that could ease long-term price pressure if demand remains moderate. However, lingering geopolitical tensions, including disruptions to Russia gas transit routes, rerouting of exports, and volatility around key choke points such as the Strait of Hormuz, continue to inject a geopolitical risk premium into the market. In short, the immediate outlook remains bullish, or at least volatile, but structural changes in supply over the next 1 or 2 years could pave the way for a more balanced, even softer pricing environment, unless fresh demand or further conflicts intervene. So we always start with the weekly chart first, and on the natural gas weekly, you can see the price is still above the moving averages, and so is the CCI, and it would have been ideal if you're trading on the daily to go long on that during that week, if you're trading according to the weekly trend. On the daily, now it's hit this resistance on our last video at 48.15, and it's still stubbornly hitting that resistance at the moment. Now you'll notice here we've got a bearish divergence happening on the CCI versus the price, almost a triple top on the price versus lower highs on the CCI. And on the daily, if we drew a Fibonacci, we took it back to that low, which is a significant low before the divergence started, and we raised that target range we had previously to that 23-38% range. That's our minimum retrace we can expect to pull back if it does so in the coming days possibly. On the hourly, we look for any micro moves. On the hourly, you can see there we also had another bearish divergence. We could probably draw it from there, higher highs on the price versus lower highs on the CCI, and that's dropping off. Now, if we drew a Fibonacci retrace on this one, on the hourly, take it back to that level, you can see there it's currently sitting around a 38% retrace level, which is it's hit our minimum, and it's currently deciding which way to go at the moment. At the moment, the CCI is still in a downtrend, which is inclined to say which more of a bearish outlook at the moment. So if you're trading on the hourly, remember we're only going in the direction of the daily, so we only take long trades at the moment. So looking at the back test, you can see here going right back to the beginning of this particular time zone. On the hourly, you would have been going along when the moving averages are in an upswing and closing it out when the moving averages start to bend down. Again, going long during that period, closing it out. Notice here as well, when you see the price and the CCI in alignment, that's a good area to go long, or to enter if you're going long, and then closing it out when at the very latest when you see the price moving averages bend down like you did there. The CCI may bend down earlier, like in this case, for example. You would have been going long during that period, price and CCI in an upswing. This was giving you an early warning. There's a divergence, but you keep staying in a trade and watch it carefully, and you probably would have closed it out at some point there on the price, like when the moving averages bend down. And you'll notice here that was giving you a warning on the CCI. Again, you could have entered on that little range there, but again, always close it out at the very latest when the price moving averages bend down. And where we're at the moment, we've got, let's do this again, where we are here. Again, I like to zoom out a bit so you can see the moving average band curving, and you would have closed out any long trades at that point at the very latest, and not being a long trade at the moment. You can see there we've got that hourly divergence that's been hit. So you would have got out of the trade somewhere there. So looking at BOIL on the weekly, that's got a fresh breakout on the price above the moving averages. But it's a bit hard to see here, but the CCI, let me just maximize that for a moment. You can see there the CCI still just hit that moving average range. So I'd call that a neutral positioning. So to be extra cautious, don't go long or short until we see a more decisive move on both the price and the CCI in alignment. On the daily, they've already broken above the moving averages. So if you're trading on the 1 hour, you can go in the direction of the daily here. So you would have started going long from that point as a fresh breakout. both the price and the CCI, and there's no divergence. Now on the back test, I started it from the 27th of September, so going long. So going from back this period, going long when the price and the moving averages of the CCI are in an upswing, and closing it out when they break below. So you would have got out there with maybe a small break even or a profit. Avoid going short, going long again there, closing out, going long again there, hold it there. Here it's consolidated. You may have gotten out there possibly, but again, I'd like to see a curve down on the moving averages. You could have stayed in there or got out, doesn't either way, and then you would have got out eventually at this point here. Little trade there, possibly break even, get out and go long again, and you'd be closing it out very shortly, if not already, when the moving averages are penetrated on the CCI. So KOLD on the weekly, that's broken below the moving averages, and so is the CCI. So bearish trades to be taken on the daily if you're trading the daily, in accordance with the weekly trend. There's no divergence there on the weekly. On the daily, again, that's still bearish. Both price and CCI are in a downtrend below the moving averages, and no divergence there. The last divergence we had was this bearish divergence back here, lower highs versus double top on the price. That broke and hit out 23-38% Fibonacci range, bounced out, and then broke down again. And up marked here with an arrow to go short from that period, and you would have been going long from this period if you're trading on the hourly in accordance with the daily. So in accordance with that, on the 20th of October, go to the hourly from that period. And what we look for here is, number one, the price is broken, just about to break into that moving average range. The CCI is already broken higher. So avoid going short at this point until we see that break to the downside, as well as the CCI in accordance with the daily trend. We did have a bullish divergence back here that broke up right into that 23-38% range and retreated back towards our trend. Hit it again and it fell further again. In terms of the back test, looking at short positions, again, short positions on the 20th or 21st of October according to our daily trend, taking in short trades according to the CCI and the price, and closing it out when the price especially starts turning up. Going short, stay in a trade. You might have gotten out there possibly, but notice that consolidating and going sideways. I'd like to see that moving average range turn up like it did there. And you could have got out somewhere possibly in that range there eventually, especially after seeing this bullish divergence. And then where you are at the moment, as I said, you probably would have closed out any short positions, especially when that CCI hits that moving average range, if you want to be very conservative in your trades. Otherwise, wait for that moving average range to start turning up on the price. So for UNG on the weekly, that's broken above the moving average range, and so is the CCI. So bullish momentum on the weekly. On the daily, that's also bullish, both CCI and price above the moving averages, and there's no divergence there. And on the hourly, what we look for primarily here is divergence. Again, neutral positioning, price is above the moving average, but the CCI is broken below, so avoid going long or short until we see a decisive move when they're both in sync. And there's no divergence currently in play on the hourly. So looking at the back test, going long only from this point, according to the daily trend, again going long on an upswing on both the CCI and the price, closing it out there. And you know the pattern, I won't go through all of it. And as I said, where we are at the moment, you would have potentially, if you want to be really conservative, close out your positions when the CCI touches that moving average range, like it could have done it there. And more often than not, it closes out near the top of that range. And then wait for another breakout to both the CCI and the price. So that would have been an ideal single trade you could have taken at that point there when it breaks out there. CCI is already above, and you're closing it out there. So again, wait for this CCI to break higher, or alternatively wait for the daily to turn to the downside and the hourly also to start going short. Also, each weekend we do run a scan showing bullish shares across 7 regions of the world, and these are some of the trades we've executed. So these are all closed trades since the 21st of September this year, and it's yielded 14.42% so far.
That's pretty good.
So to get access to that scan, consider subscribing to the Patreon page, links in the description below. Thanks for watching, hit that like and subscribe button, and we'll see you in our next update.